Good afternoon. Welcome to Bowers & Company CPAs webinar on the New York State budget just recently passed. I'm David Ayoub. I'm a partner with Bowers & Company. I'm joined here today by a couple of my partners in the tax department. First, Rich Smith. Rich rejoined the firm last fall after a number of years away, and we're glad to have him back. When Rich came back, he brought with him Greg Jarvis. Greg is one of our talented tax professionals in our tax department, who we're equally glad to have. Also in the room with us is our marketing director, Taylor Howell. She put together today's presentation. Thank you, Taylor. The presentation today is about some of the key provisions in the 2021-22 New York State budget. Those key provisions we plan to discuss are focused on the new pass-through entity tax, the changes to the corporate and personal income tax rates, as well as a few other notable changes. The key items of today's presentation of the pass-through entity tax will affect, or can affect, every S corporation and partnership doing business in New York State. And when I say every S corp and partnership, I mean every S corp and partnership. So pay close attention today if that's how you do business. So I know there's going to be numerous questions, and we'll get to as many as we can, but we're going to do that at the end of the presentation. Contact for the three of us presenting today will be provided, but if you've got a contact here at Bowers, feel free to contact them directly. In addition, a PowerPoint of the presentation and a recording will be posted to the website shortly hereafter. Given the fact we've got a large audience today and expect many questions, let's go ahead and get started. So at this point, I'm going to turn it over to Greg to get us going.
Thank you, David. So in the next segment on the pass-through entity tax, we're going to cover basically in three parts. We're going to go and discuss what the tax is and the origin of the tax, how mechanically the tax works, and why it's important for every pass-through entity to consider electing into this regime. As David said, we cannot overstate the importance of these provisions and the potential benefit for pass-through entities. We think it can be a huge benefit for many of these, and we wanted to get this out and make sure that we cover it in detail based on how things stand now. So just some general background on the pass-through entity tax. Even though the budget bill was passed in April of 2021, this applies beginning with January 2021 and all years thereafter. It's an elective program, meaning that entities do not have to participate, but they have the election to. And the premise of this tax for New York State purposes and why it's beneficial for pass-through entity owners is that it's a workaround of the $10,000 limitation or cap on the state and local tax deduction for individual taxpayers.
Yeah, that's the SALT deduction that you hear a lot about in the news, isn't it, Greg?
Yes, that's correct. Back in November 2020, there was an IRS notice that clarified that when a pass-through entity makes a tax payment, an income tax payment, that's a valid deduction for federal tax purposes. And that was the main premise of New York State implementing this tax. We've seen other states do this. Connecticut and New Jersey are both examples, and now New York State is following suit.
And this isn't an itemized deduction, is it? Like the state and local tax deduction we've had in the past, and we still have to some extent. This is a little bit better, isn't it?
Yeah, this is definitely better. This is a deduction in computing your ordinary or taxable income. It's not a separately stated item, so you don't have to worry about any $10,000 limitation for this deduction. So it's a very, very advantageous provision from a federal tax standpoint.
Beautiful.
So. In the last note on this slide, it's intended to be a revenue-neutral tax to New York State. So what that means is, in the premise is, your dollar-for-dollar tax at the pass-through entity level is going to be credited at the individual level or owner level, and we'll see that in one of the next upcoming slides here. Some general provisions for the pass-through entity tax. Because, as I stated on the previous slide, the bill was not passed until April 2021, the taxpayers have some time to consider this election during the 2021 tax year to make it apply. The election must be made for the 2021 year by October 15th, which is not the general rule. For 2022 and future years, you have to make the election by March 15th. Estimated tax payments are made in quarterly installments, March, June, September, and December, the 15th of each month of those. And the above, all of these rules apply whether the pass-through entity is a calendar or fiscal year taxpayer. In general, most of our pass-through entities are calendar year. There may be some exceptions for S corporations that have been around a long time. So two other notes that I wanted to cover. Similar to the regular pass-through entity, partnership, or SCorp return, these annual returns are going to be due March 15th. So it's going to be due the same time as your federal partnership or SCorp tax return. And currently, as it stands, when it comes to the estimated tax payments, our understanding is that individual owners should still be making their individual quarterly estimated payments for 2021, and the entity should not be making estimated tax payments at this time, based on what we know currently.
Right. So, and right now, we don't really even know how to make this election, do we? They haven't given us any real guidance. This is just law.
Yep, that's correct. So the law tells us we need elections and we need estimated tax payments. As it currently stands, we don't have a form or method or guidance formally out there that will allow us to do either.
Exactly. Okay.
When we expect that to come in the coming months, as we get closer to the end of the tax year. So these next two slides are going to cover the mechanics of the tax, and after this, we will have a handful of examples that sort of put it all together. The tax is imposed on taxable income sourced to New York State, and the graduated tax rates vary from 6.85% at the lowest bracket to 10.9% at the highest. We're going to cover the individual tax rates in later slides here, but you'll see that 10.9% is higher than the top tax bracket that was in effect for individuals for prior years to 2021. As we discussed on a prior slide, the pass-through entity tax paid by the entity is a valid deduction for federal tax purposes on the pass-through entity's federal income tax return. Upstream owners or partners of the pass-through entity will get a credit on their tax return for their proportionate share of the tax paid by the pass-through entity. And finally, the credit is when you get to your owner, your individual return, if you're an owner of a pass-through entity, your credit can be treated as a refundable overpayment if, for instance, you have other facts and circumstances on your return that would cause you to have no tax outside of your share of the pass-through's income.
Correct.
What we don't know is all this information we assume will be disclosed on a Schedule K-1 or equivalent form. That's what's provided in the law for this. We don't know how or what the form's going to look like at this current time, but we do know that this will be disclosed to all owners. And then the last thing that we don't know is that if an entity makes estimated tax payments for 2022 and future years, and the estimates end up being more than the actual tax, we don't know what happens at the entity level with that cash that they may have overpaid.
Right. So they may calculate it based on $1 million of income, and then when all said and done, taxable income is only $800. The pass-through entity is overpaid and has some type of hopefully some type of refund. Worst case, a credit for the future years.
Right. That's correct, and we assume that's similar to the rules for an individual or corporate taxpayer. We assume that they would apply, but there's currently no regulatory or legal guidance in that matter. This is the most important slide, I think, in this presentation on the pass-through entity tax. This distinguishes, there is a difference between the mechanics of the calculation of the tax between partnerships and S-corps. For a partnership, the tax is calculated based on the sum of the two items noted in these sub-bullets below. So you take, if you're a resident partner, you take your share of taxable income, and if you're a non-resident partner, you take your share of taxable income that would be apportioned to you on your New York non-resident tax return.
So if I'm a partner in a partnership, actually, which I am, the income that I would get a credit for is 100% of the partnership, my share of the partnership income, regardless of whether or not we do business in other states.
Yes, that's correct, and that's based on the individual income tax rules. David, as a New York resident, like you said, when you file your New York personal tax return, you're taxed. If you had other sources of income from other states, you would be taxed on a worldwide income.
Right.
So that's the premise for.
And if I'm a Florida resident, yep, and the partnership has an allocation percentage in New York of 30%, that's all I'm going to get a credit for.
Correct. You would pay tax on your share, your 30% share of the total partnership income allocated to you.
Okay.
And we'll see those examples on the upcoming slides.
So an S-corp is different?
Yeah, an S-corp is different, and this is an interesting bullet here. The taxable income for the pass-through entity is, the credit is imposed on income apportioned or allocated to New York, regardless of residency status. So what does that mean? If David, as a Florida resident, is a owner of an S-corp, and the S-corp only derives 50% of their income from New York State, he ends up getting the same credit as a resident owner would. So the New York owner would only get a pass-through entity tax credit on 50% of the income.
Now that's different than the partnerships. It can be extremely different, but they're both pass-through entities.
Yes, it's extremely different. The legal reasoning that we think at the time is partnerships have an avenue to allocate deductions or credits, that have economic effect, to make sure that everybody is treated equally, and S-corps don't have that provision.
That's true.
So S-corps, in the regime as it currently stands, they have a bit of a different treatment, which is unfavorable to S-corp owners, especially those that have, we'll see an example of this. If you have all your partners, your owners are New York State residents, but you don't derive 100% of your income from New York, then you're going to get a little bit harmed. You're going to have and it's not economically, in total, it works out. Like we said earlier, this is a revenue neutral tax. So the economic harm is that the S-corp owner will have to kick in the remaining difference at their personal tax level to make up for the pass-through entity tax credit they're not getting.
From what I've read so far, Greg, this is the experts out there and some of the attorneys who deal in New York State exclusively, what I've talked to, are not sure. They have their suspicions as to why this was written this way, but they're well, it's in the law. They're not sure it won't change in the future or have some type of cure to make it a little better for the S-corp owners.
Yeah, we're hopeful. There's no economic, real mechanic that we think that they should be treated differently. We just, this is how it stands at this current point in time. And like I said, this is June. There's a lot of things that could change in the upcoming months. Right. So we're hopeful that the S-corp, they'll realize this, and there will be some sort of provision to undo this distinction that they currently have.
Correct. I would agree.
So final one keynote, if regardless of entity structure, if 100% of the income is sourced in New York State, the pass-through entity tax and the related credit in total is the same. And we're going to see how this works on the next handful of slides here with some examples that we'll cover in brief. Segueing off my last note, this first example takes a typical fact pattern that we would see from our client base here. We've got pass-through entity that has 100% of their income derived from New York sources, and we'll say that based on taxable income prior to the tax is $500,000. The resulting tax is $34,000. What happens is the entity will get a tax deduction on its federal return of $34,000, and the credit will get split 50-50 between the two owners in about $17,000. That $17,000 will be disclosed, and they will take advantage of that credit on the New York State tax returns.
So the $34,250, let me make sure I got this right. That's a tax deduction that the entity gets and passes through to its owners. And that would be a reduction of their federally taxable income.
Yes, that's correct.
Great. So that's something we didn't have before, or haven't had in the same vein even before the SALT deduction. So that's a real nice benefit. And then at the state level, we're really in the same spot in that we're going to get credit for that $34,000 in terms of $17,000 to each partner in this case.
Yep, that's correct. So that $34,000 federal deduction is not allowed for New York State. So we end up getting back to the $500,000 in New York State taxable income with a corresponding credit of $17,000 per person in this example.
Perfect. Thank you.
The next slide covers an example with, let's say we have a partnership with two equal partners, and they're both non-residents. Let's say they're both Pennsylvania residents, but they derive 100% of their income from New York sources. What happens here is, when they file their non-resident return, they would include 100% of their share of the entity's income on their New York personal return. What happens is the tax, the deduction, and the credit are all the same as if they were both both resident partners. The key distinction here is, as we noted on a couple slides prior, the residency of partners is not relevant since all income is apportioned to New York State. So this is just a summary. We can put some hypothetical numbers just to see how that works. The next example is the exact same example as the prior slide, but addresses the situation where we have two SCorp owners that are equal, and the SCorp owns operates 100% in New York State. Again, the residency is not relevant since 100% of the income is apportioned to New York State. The entity is still paying a $34,000 tax, and the owners are still getting a credit of $17,000 disclosed to them that they can use on their individual tax returns. So the next couple slides, this one's a partnership example, and the next one's an SCorp example. It comes to the real meat of what we were talking about earlier. So in this example, we have a partnership with two equal partners, but one's a resident of Florida and one's a resident of New York. And in this example, we're using a 50% apportionment factor in New York State. Still with the same $500,000 and the same tax rate. What happens is, let's say David is the resident partner. He's going to get taxed on 50% of the $500,000, which is $250,000 times the tax rate. He would have tax and a credit of $17,000 on his share. For this example, let's say Rich is a Florida resident for this. He's only going to get taxed on 50% of his 50%. So he's going to get allocated $250,000 gross, but he's only 50% is taxable in New York. So what happens is the share of his tax and his credit is about $8,600. So it's important to see there, the non-resident is only, this economically makes sense. As a non-resident, Rich is only taxed on his income allocated to New York.
This seems like the most reasonable situation when you've got resident and non-resident people in doing business in the form of a partnership.
Yep. This economically makes sense. We agree with how this would work in practice. What happens is then, instead of the $34,000 credit and deduction in total, we have a total tax, total deduction, total credit of about $26,000.
Makes sense.
Which, right, it makes sense, and it's basically gets you exactly in the same spot as if you were taxed personally.
A lot of numbers there, Greg.
Not sure how else you want to show it, but
yeah, I mean that's the way to explain it.
So the last example is this SCorp trap that we currently have. Same deal. We're saying David is a 50% owner of an SCorp, lives in New York rather. Rich is a 50% owner of an SCorp, lives in Florida. The SCorp has 50% New York State apportionment. What happens is, because of the way the law is currently written, there's only a 50%, the tax is only imposed on the allocable share of income allocated to New York, which is, in this example, 50%, which reduces that overall potential credit, deduction, etc., from $34,000 to $17,000. What happens is then, because it's an S-corp, everything has to be allocated and distributed equally between the owners. The credit for each owner will be about $8,600.
So the difference, well, and we're going to get to that. So I took a major reduction in the amount of deduction I could get at the federal level, and I got less paid in for me at the state level.
Yeah, no, that's a good point. The S-corp owner in this scenario, the New York S-corp owner, is harmed both from the sense of paying more tax personally than he should have, and from a federal side, right, by way of a smaller deduction, and he also has to chip in on a personal level to make up for the remaining 50% of S-corp income for which he doesn't get a credit.
The company didn't pay anything in for me, right?
However, the non-resident is not, he's not treated any different if you were a partnership owner in this case. Same 50% deduction and credit for the federal and for the New York State.
So New York State is treating outsiders better than it's treating their residents.
Well, yeah, I mean, it's been doing that for years, right?
Oh, boy. Okay.
So this is just an example of putting everything together. You'll see that, by way of this nice little summary table, if you don't want to, this summarize all the main scenarios that you'll see.
Right. Nice summary.
So this last slide, we're just going to go through a couple of observations. The first thing to note is the tax is computed at the pass-through entity level without regard to tax credits generated. So let's say you have a pass-through entity that does some manufacturing and may have some investment tax credits. Those investment credits do not reduce the pass-through entity tax. They still get passed along to your owners on their K-1s or equivalent forms. And what happens is, the pass-through entity tax gets paid, and you get a larger credit. What likely would happen is that on the individual level, you're still getting that deduction from a federal standpoint, right, and you're getting a credit that is refundable. So you're still getting the cash.
So if the pass-through entity calculates a deduction and then passes through the credit, and I can't use it all at my individual level, I'm going to get a refund for that. I can get a refund for that or apply it to my next year, whatever I want to do with it at my level.
Yes, that's correct. So that's why we think that there's very limited application for an entity that has income to not take advantage of this.
I would agree with that.
So that's one of the biggest things we wanted to harp on.
Okay.
The second bullet, again, we made the comment earlier that New York is still requiring estimated tax payments for individual owners at this point in time, even if we think that the passer entity is going to elect and make a tax payment by March 15th of next year, 2022.
Yeah, when I first read that, that's actually part of the law. And when I read it, I consulted with a particular attorney whose job this is 100% of the time, and I said, "What is this? Am I reading this correctly?" And the response was yes. And I go, "Well, how can that be? We could effectively be paying twice on the same income." And again, they're just deposits, but it's a cash flow issue, and we're talking about businesses, and cash flow is a huge issue. And he said, basically, because New York State is greedy and because they can. Now, and it's not to be funny, that's just that's their comment from a person people who deal with New York State on a daily basis, and I guess I'm not surprised.
Right, and thinking about it from a budget fiscal year perspective, New York's budget year ends March 31st. So the entity is paying the tax March 15th and then refunding the tax in April 15th of the next fiscal year. Is this something just to make the budget balance for this year? Could be. It's not outside the realm of possibilities. And finally, there's really no guidance or regulatory examples on this yet, but if you're a partner in a partnership that flows through a tiered structure of entities, there's going to be some additional complexities. Which entity are you electing into the tax regime? Are you doing it for all? Are you only doing it for the top level, et cetera? There's no real guidance on that yet, but it's, you have to sort of go through the gyrations at this point in time based on the absence of really anything better.
Right. So at the end of the day here, Greg, with this new set of rules for the pass-through entity taxes, if I'm a cash basis taxpayer here in 2021, I'm going to run through the calculations, and it benefits me. I probably need to make my payment by the end of this calendar year, correct? Being a cash basis taxpayer?
Yes, that's correct.
Okay. And if I'm an accrual basis taxpayer, I guess I get a little leeway. I can book the accrual and then pay it by March 15th.
Right. Theoretically, if you're our financial statement clients that are on the accrual basis, you'd have to consider this.
I would agree with you.
So
because it is an entity level
yep.
tax, and by if you're cash basis, it makes sense. We got to pay it to get the deduction, so we have control. Right now, as we said, we don't know how to pay it, but that would be. So these are the things to keep in mind in terms of what we need to do to take advantage of this credit for the 21 tax year.
And we're certainly hoping that by November, December, we have some avenue to make an estimated tax payment so that we can, if cash flow permits for our clients, right, make a payment to get that federal deduction for the 2021 tax year. Right.
It's just interesting to note that they require taxpayers to continue making their quarterly estimates as they would. If you think you need to make them, you make them. I'm not sure how they're going to police that, but I don't think that's a topic for discussion here today. But that's just an interesting question that's come up.
Yeah, and it's many clients, right? We're thinking about this. June 15th is just around the corner, and they sprung this on. This law kind of passed right when we were wrapping up tax season. Now we're back into this and, thinking about 2021 already. So, it's like I said, every past serenity we're looking at this for, and because of the potential benefit that can have for every New York State business.
And, if they do come out with additional rules and they've not, I'll say, corrected this situation with the SCorp and resident shareholders, we've been talking about a couple of things that we may be able to enhance that deduction for them, but that'll take a little doing, and if we need to get to that, we will with the individual clients. So, Greg, thanks a lot. At this point, Rich, let's move on to the next section.
Sounds good. Just a quick reminder, we did leave some time for questions at the end. There should be in the toolbar, the webinar toolbar, spot for questions where you could type the questions in. With this format, with the amount of people on it, we're not actually taking live Q&A, but if you type in a question, if you have a question, as we go along here. Just type it in. We'll pull them up at the end, and we'll try to get through as many as we can. But just wanted to make a reminder that that's how we're going to handle the questions. So moving on to some other items in the budget bill. Obviously, the pass-through entity tax is getting a lot of the publicity, rightfully so, as Greg walked through. It's a nice benefit for our partnership and SCorp clients. There were a lot of other things in the bill. We're not going to cover all of them. Some of them do not have a wide application to many people, so we're not going to waste a lot of time on those today. We are going to hit on a couple things here and kind of break it down quickly between individual and corporate. For the personal income tax changes, we're going to talk a little bit about the tax rate increases that came in, a new excess real property tax credit. This is really geared towards what New York State defines as a middle-class taxpayer. And then just a decoupling that New York has done from qualified opportunity fund gains, and these are just a type of investment vehicle that the gain is deferred for federal. New York is decoupled from that. We'll talk a little bit about that in a minute here when we get to that slide. So tax rate increases. Up through 2020, the top tax bracket for New York was a flat 8.82% for married, when married filing taxpayers got to 2.155,350 of taxable income, and you'll see it's obviously lower for single taxpayers. So essentially, once you got over that amount, you were taxed at 8.82% on everything over that. The budget bill, as I'm sure some of you have seen in the news, has significantly increased that tax rate, and it's done so for a limited time. But you'll see there's some new brackets that exceed that 8.82, which lines up also with the pass-through entity tax brackets. So as Greg mentioned earlier, there was the thought was for this to be revenue neutral. That's what this has done as well, so that when you're paying tax, presumably at the same rate for the pass-through entity tax, you're going to get hit at the same rate at the New York State level, so the credit would wash through. Obviously, there's other factors that may or may not make that happen, but that was obviously the intent. But the three new brackets you'll see here starts with at the 2.1 million number for married filing taxpayers. That's now jumped to 9.65%. Once you get over 5 million and are between 25 million, and now this is the same for married filing jointly and single taxpayers, that rate jumps to 10.3. And then once you exceed 25 million, so our super wealthy individuals here, you're going to be up at 10.9%. So some pretty big increases. Obviously, the larger ones hit a much wealthier segment of the population, and that was clearly the intent here, was to get additional tax from the wealthier taxpayers.
Well, Rich, that's going to hit a lot of our clients. I mean, we've got a pretty robust client base, and those numbers, we probably have a significant number of taxpayers that this will affect. So as far as their estimates go, though, this being a new law, if we're basing their current year estimates on the prior income, we're okay.
We're okay. You may owe when you get to your tax return going forward, but if you're basing it on the current year tax, you'd be okay.
You'd be okay from a penalty standpoint.
Correct.
Okay.
Yep.
Okay.
Yep. And this is effective for 2021. So.
Right.
Yep. And as noted at the bottom, this is currently scheduled to sunset after 2027. Absent some additional legislative change to make this permanent, we'll revert back to the 8.82%. And as David noted, this is going to impact a lot of our clients, obviously any wealthy New York taxpayers. So Dave's going to do a webinar later on establishing residency in Florida for all of our taxpayers. So be on the lookout for that.
I think it's a great idea.
Moving on, I'm just going to cover this real property tax credit. This is a new credit. It's limited for a 2-year window, 2021 to 2023. And as I mentioned, the way this was kind of publicized was geared towards the middle class. So you'll see here it's available to homeowners subject to some limits, one of which is less than $250 of adjusted gross income, and then 6% of your income has to be paid towards property taxes. What that essentially means that when you take 6% of your AGI, if that's less than the amount of the real property taxes you paid for a current year, you're going to have some excess amount of real property taxes that are going to be eligible for this credit. The credit's going to range between $250 and $350 per year, and it's computed based off of that excess, 14% of that excess property tax. And it phases out between 75 and 250. So again, once you get over 250 of adjusted gross income for New York purposes, that's going to you're not going to have any credit. If the computed credit is less than 250, you get nothing. So a couple quick examples just to see this in practice. You'll see here a taxpayer with $75,000 in AGI. They paid $7,500 in property taxes. Getting to that 6% number there, right? 6% of the 75 is 4,500. So that's obviously less than the property taxes that they paid. So there's some 3,000 in excess property taxes. 14% of that is 420. That's higher than the maximum amount allowed. So their credit in this instance would be limited to 350.
That seems like a lot of work for $350, doesn't it, Rich?
It does. But I'm sure New York will have a form that will add to our tax return compliance that we'll have to fill out to take the $350 credit.
I have no doubt.
Moving to the second example, this is really just showing how the phase-in works, or the phase-out, I should say. 100,000 in AGI, we've got 10,000 in property taxes paid. Again, the 6% gets us an excess of 4,000. But because we're over 75,000, we get reduced. That 14% is reduced. It's 12.33, and we're at $493, which actually exceeds the 350. Again, we're limited to $350. So again, I'm sure this, I don't know how many people this will hit. It's a new credit. We wanted to mention it so that people are aware of it, given the property tax state of New York. There could be a decent level of taxpayer who fall into this category and are able to take advantage of it. And I'm sure New York will issue a form and it'll take care of the calculation itself. But just wanted to mention it. It's out there, and it may be something that's beneficial to people. The Qualified Opportunity Fund, this was just real quickly, I'm not going to go into great detail on what they are, but just for anyone not familiar with them, these really were established as a means to attract investment, or private investment really, in distressed areas. 90% of the assets in these, and a lot of times they're held in partnerships, 90% of the assets have to be invested in these distressed qualified opportunity zones, so they have to be designated as zones. But it was really meant as a mechanism to, again, attract private investment into some of these distressed areas. The way these work for federal purposes is you're able to defer gain on these until 12/31/26, and so the gains, as you have gains in them, unless you sell your investment in the partnership, you're able to continue to defer that gain. New York has essentially come in and said, we're not going to follow that deferral provision, so as you have certain events that happen for federal, or within these funds, that you're able to defer for federal, New York has said, we're going to require you to pay tax on that now. Then at a later date, when you do ultimately either sell, or when you get past 12/31/26, New York's not going to make you pay tax on that again. So you would have some type of modification there. But these are, I would say, not overly popular, but gaining a little bit of popularity. So we wanted to make you aware of it, especially so as part of the budget bill, that, as you're deferring, some of the benefits of these are being able to defer that gain for federal. You're not going to have that for New York State.
So my clients that got in, our clients that got in 2020, who finished their reinvestment, they're okay for federal and New York purposes.
Correct. This is after January 20. Good tax planning, Dave.
Yeah, that was great. That worked out.
Good job on that. So those are, again, there's some other credit type, smaller credits and different things in the budget bill on the personal income tax side. They're not, widespread application of those. We're not going to spend time on them today, but if you do have a desire to read the budget bill for any reason, you will see them in there. If something's applicable to you and you have questions, we're happy to address them. Moving on to the corporate franchise tax changes. Similar to the individual side, we've got a rate change. The rate's been at 6.5 for a while. It's going to change to 7.25, but that applies to businesses with more than $5 million in business income. This is for tax years after 1/1/21. Interestingly, in the 2 subsequent years, it appears to be a cliff type structure in that once you're over the $5 million, it appears all of your income is going to get hit at the 2.5% versus a graduated rate. So anyways, just as our taxpayers who are over that number are going to experience a rate change, and again, for 2-year period here, absent some legislation that makes that permanent. Reinstatement of the capital-based tax. This was scheduled to phase out, actually with 2020. They've gone ahead and extended that. It's going to extend for 2 more years. That's, for our taxpayers who might be experiencing losses and weren't paying on the income-based tax, this is basically a tax that can be based on your capital, your investment in your entity, to try to capture some level of tax above and beyond the min tax that applies in certain situations. So for anyone who was getting hit with that thought they were going to get out of that after 2020, they've since reinstated that.
So Rich, on the franchise tax though, if I'm a manufacturer, I'm still at 0%.
You are still at 0%. Okay. We'll cover that in a minute, but yes, that did not, actually we can flip to the next slide. So as Dave just mentioned, he's seen this presentation before, I think. But as Dave mentioned on the franchise tax side, if you're a manufacturer, those of you who are manufacturers may recall New York allows a 0% tax rate if you're a qualified manufacturer, and I won't go through the rules of that, but there's rules that you have to meet to be a qualified manufacturer. But if you are, then you're essentially exempt from the business income tax base. So that rate increase that we just went through is going to be a non-event for you because you're going to be at 0%. And then the same applies for small business taxpayers, net income less than 390. You're still will continue to be exempt from the capital-based tax, even though that is still going to be extended and carried out for another 2 years. Those 2 rules did not change, so those will still apply. Moving on, this next section on NOLs, this is actually not part of the budget bill. These are changes that took place where New York decoupled from the CARES Act, but we wanted to just kind of revisit them as 2020, if you haven't finished up your 2020 returns, as just something to think about, as you're finishing them. So essentially what happened with last year's budget bill is New York confirmed that they follow the Internal Revenue Code prior to the passage of the CARES Act. Why that's relevant, the CARES Act from a net operating loss perspective adjusted the carryback period for losses generated in 19 and 20 to allow for a 5-year carryback where it had been 2. For New York, and at one point was suspended entirely. So as you'll see here, prior to the CARES Act, you couldn't carry back losses, and then as you carry losses forward, they were only able to offset 80% of your current year income as opposed to 100%. And then any of our taxpayers who had significant losses from pass-through entities may have run into this excess business loss issue, which was a new law for related to limitation on losses. Essentially, if you were over a certain threshold, I believe it was 500,000, you could not take those losses on your individual tax return. They essentially were capped, and then they were layered in as an NOL. So what New York did was the CARES Act got rid of those things. The excess business loss was removed for 19 and 20. They allowed this 5-year carryback. New York came in and said, we're not going to follow those things. So when you're looking at a 19 or 20 return for New York, one, you've got to look at that excess business loss issue for New York. But also, two, if you've generated a loss in those years, while you can carry that back for federal, you're not able to do that for New York State. So you've got a difference in your NOLs from an individual perspective between Fed and New York. And why that's important is, I think with that 5-year carryback, what taxpayers were seeing is who generated losses in 19 and 20 when you start going back to 13 and 14 and 15 in those years, depending on what bracket they were in, the individual tax brackets were higher in those years from a federal perspective. So it was making a lot of sense to carry those losses back for federal. But again, you didn't have that option for New York State. So for those of you who maybe haven't finished up your 2020 returns, or you think you're going to have a loss, an NOL, and you're thinking about doing a carryback, or you've done 19 or 20 and haven't done a carryback yet, just keep in mind you're not going to have that option for New York. That's going to be a Fed-only benefit. And moving on to the next slide, essentially what I'm saying here is, for your 19 and 20 losses, you're going to have to carry those, or for federal, a lot of people are carrying those back to take advantage of the rate differential, or, just to get cash back. It makes sense. For New York, you're not going to carry them back. You're going to carry them forward. I will say, and I don't necessarily agree with this, but there is some debate. I have seen some commentary where, because of the way the New York State rules work for individual NOLs, where New York has a limitation, it's the lesser of your taxable income or your Fed NOL deduction. There's been some commentary where if you've carried your individual NOL back for federal and you now no longer have an NOL, that when you go to use it for New York going forward, let's say into 2021, and you now don't have a federal NOL deduction, that New York would say, well, the limitation is zero for New York because you have no Fed deduction. That's the lesser amount. I have not seen anything in writing from New York State that says that. I think that's just some commentary that's out there, an interpretation of the rules. I wanted to make people aware of it because that's how the rules read. But I do believe in the past, you've been able to calculate a federal as-if deduction and rely on that to take your NOL deduction for New York. So my expectation is you'd be able to do that going forward. But I did want to mention it because I have, in what I've read, seen some commentary about that. So just be aware of that.
Yeah, these rules, Rich, as you know, the federal side have been very helpful to some of our clients who, had a kind of a rough year in 2020, some in 19, and extremely beneficial provisions. Unfortunately, we got about 9 to 10 minutes left. We do have a slide on some Biden's proposed tax changes, but before we got into that, Rich, let's I know there's not any real questions up there yet, but going back to the pass-through entity tax, I had a couple of items that let me throw out to you guys and see where we stand. The fact that we're going to get a deduction at the federal level for the taxes, this pass-through entity tax that's going to get paid, what does that do to our qualified business income deduction?
So, in general, this is going to reduce the amount of deduction we get for qualified business income, as the deduction for the tax will reduce our amount of qualified business income. So, taxpayers will still receive a benefit on their federal taxes, but it ends up getting reduced by the amount of qualified business income deduction going down.
All right, so a slight negative.
Yep.
I can see that. What about if we're a partnership, the self-employment income that the partnership income generates?
Right, so that's another good question, David. The self-employment income is also should go down as well, and this is a positive in general. So, the self-employment tax for a partnership is, basically assessed on the flow-through earnings, and by reducing the amount of flow-through earnings, we're reducing the amount of self-employment tax. So that's a benefit as well. And generally, we think that sort of is going to cancel out or offset the negative effects of losing the QBI, the portion of the QBI deduction, depending on income levels and phase out and things like that.
Right. Well, that's not too bad then. That's not too bad. So I just wanted to make sure we got those in because those were, I'm sure people in the pass-through realm are getting used to getting those that QBI deduction. So knowing that we're going to take a little haircut there, but if we're a partnership, we'll get a little of that back and less self-employment income.
Yep.
Okay, so we've got a few minutes left. Rich, why don't we go ahead and hit those Biden tax notes?
Yeah, and before I hit those, just one last word, I guess, on New York and the budget bill. Like I said, there's a bunch of other things in there that we're not covering. Just a couple things I saw that
Great, thanks, Rick.
So our Biden tax notes, I'm not going to go into an incredible amount of detail here because these are proposals. There's no law on this. It's what he is thinking he wants to do. Whether any of these come to fruition, we'll have to see. And like anything with tax law, the devil will be in the details on any of this stuff.
Good stuff to know, though. I mean, it's you know, they're pushing hard, and these are significant.
Absolutely. So. The ones that are probably getting the most attention that anyone who's been paying attention to his proposals are these top two here. An increase in the top marginal individual tax rate for high earners, so that would go back to the pre-Trump era, I guess, of 39.6%. That had been reduced to the 37%. And then another one that is getting a lot of publicity and is an attempt to generate some tax from our wealthier taxpayers is an increased tax rate on long-term capital gains and qualified dividends for taxpayers with adjusted gross income of more than $1 million. Currently, the tax rate on those is capped at 20%. If this proposal were to actually become law, what would happen is those rates, if you're over $1 million and you have long-term capital gains, that rate would be taxed at whatever your ordinary rate is. So if you were at the top bracket of 39.6%, your rate on capital gains, long-term capital gains, could go up almost double. So it's significant, but again, it has not passed yet, but it has quite a bit of,
Well, and when you look at that, I don't disagree with you, Rich. When you look at that and you throw in the Obamacare tax, 3.8% at the federal level, add in your state tax rate, I mean, you're over 50%.
You are.
That's a bit of an oppressive rate to pay on capital gains.
Exactly, and as mentioned, New York had in their proposal an additional tax on cap gains that didn't make it in. So
we're getting to the point where if you have a capital gain, you may have to pay them on top of everything else.
Yep.
More than the gain.
Exactly. So just a couple other items in here. His proposal would make permanent the expansion of the earned income tax credit to taxpayers without children, extend the child tax credit increase through 2025 and make the refundability of that permanent, increase employer-provided child care tax credit for businesses. This is a credit that businesses get for providing child care. And this is another one that you may have seen some publicity on, increase the corporate tax rate from the 21% it currently is at to 28%. He does have in there, and this is going to hit your uber wealthy Amazons of the world, but 15% min tax on book income. I think the number is like $2 billion of book income, but clearly trying to tax those large corporations like Apple and Amazon who show no net income because of tax strategy and or tax planning, I should say, and hit them with the book income before those tax deductions. And then the last three, two of the last three, and repeal and reform tax benefits related to foreign investment and create tax credit for onshoring a U.S. trade or business. Clearly, he's thinking about targeting some of these foreign investments that are generating some of these benefits, and then, coming back with some type of credit for, moving some things back to the, back onshore for the U.S. trade or business. And then, there's a credit that would be out there for tax incentives around renewable and alternative energy, moving to that, rewarding taxpayers for investments in that type of energy.
Well, Rich, I got to tell you, based on my experience, that one page of bullets would generate thousands of pages of tax laws and regulations.
It absolutely would. Yep.
That's unfortunate, even though that's the business we're in, because these are only going to negatively impact our clients and taxpayers. So thank you for that. Right now we're just a couple minutes before 1 o'clock. We don't have any particular questions from the audience. So we're going to end our webinar, but remember, you've got our contact information. If you've got a contact in the firm besides us, feel free to call them with any questions about today's webinar or anything else. And we look forward to seeing you at our next webinar. Thank you very much.